Welcome everyone to the ISM Rochester membership meeting. I'm Kathy Perna and will be the facilitator for tonight's program. I would now like to introduce Leo Fisher, the chapter president.
Good evening, everyone. Welcome, and I thank you for joining us. I also have to apologize for being so late in getting these meetings together, but hopefully we're back on schedule now. I hopefully will have for the rest of the year here monthly meetings and a webinar. And the webinar will be next Wednesday, and we'll deal with LinkedIn. Kathy will have more information for you on that. And watch your emails for upcoming events, check our website, and also our LinkedIn page. Kathy, I turn back to you.
Okay, thank you, Leo. Just a few housekeeping items for tonight. Please make sure to use the Q&A or the chat function for any questions. And please, we encourage you to ask questions, especially on this topic, since we have a great expert joining us today. And we will email everyone a copy of the presentation along with your continuing educational credit. At this point, I would like to now welcome our speaker for tonight, Tom Cook. Tom is the CEO and Managing Director of Blue Tiger International, a premier international business consulting company on supply chain management, trade compliance, purchasing, global trade, and logistics. Tom was the former CEO of American River International in New York and Apex Global Logistics Supply Chain Operation in Los Angeles. He has over 30 years experience in assisting companies all over the world to manage their import and export operations. He is a member of the New York District Export Council, sits on the board of numerous corporations, and is considered a leader in the business verticals he works in. Tom is also the director of the National Institute of World Trade, a 30-year-old educational and training organization based on Long Island. And now I'm going to be turning the program over to Tom.
Okay, good evening, everyone. So you had the introduction there, and the topic obviously is Incoterms. And this was a specially arranged event by Kathy and Leo, who we need to thank for setting this up. It was by special request. So being that it's really a tailored event for your organization, I encourage questions throughout the session. You just go through the chat function or the question function and ask the question, and we'll try to respond. The more interactive that we make it, the better the session will be. So the whole subject is about Incoterms, and I'm going to take you through a tutorial of what they are, and I'm going to take you through the choices that you have. I'm going to talk to you about the challenges with Incoterms, and I'll talk to you about the consequences. I'll share a couple of case studies with you. At the end, the best practices is, in our experience, and as was said, we've been doing it for more than 30 years, we've learned over those years what really are the best ones to use when a company is importing, they're sourcing from overseas, or the companies that are selling overseas where you have export activity, really what your best choices are. The history related to Incoterms is that in the mid-1800s, the Chamber of Commerce located in Paris, France, made an attempt to try to standardize some of the trading terms that were used back then, of which the most common term was FOB, meaning free on board, a transportation conveyance, typically then would be a vessel. And they never got any traction in doing it, and they made several attempts over a number of years. And it wasn't until 1948, just after World War II, that the Chamber of Commerce in Paris was successful with Incoterms, because back then in 1948, they were just forming the United Nations. So now you had a body that had some governance and influence on world affairs, and they agreed to sign on to Incoterms. So here we are now in 2021, and if a company, a country belongs to the United Nations, then it has agreed to use Incoterms in its international trade. And another factor that was set up in 1948 related to Incoterms is that they set up a process that approximately every 10 years, the Chamber of Commerce in Paris, which is the primary agency managing this process, they're required every 10 years to update the Incoterms to a much more contemporary jurisdiction relative to the time that it now comes out. So I actually have in my office the original Incoterms when it was issued in 1948, and then it wasn't actually until 1960 when they revised it, then 1970, 1980, 1990, 2000, 2010, and 2020. At the beginning of this past year, in January and February, we actually did a lot of Incoterms seminars in focusing on some of the differences between the new 2020 ones and the one from 2010. And I will briefly go through that, although there wasn't much changes. So you can see a chronological history here. And a lot of these slides are ones that I'm not going to necessarily specifically talk about, but this whole PowerPoint, which Kathy mentioned is she's going to send to you, actually has value because it really is a good tutorial if you want to turn this around to an in-house function, or if you just want to have it as a reference for the subject. So one of the important things about Incoterms, particularly for companies in the United States, is understand that they have actually no jurisdiction in the United States. Okay, we have agreed to use Incoterms in our international business, okay, by our arrangement with the United Nations and being a member, but nowhere in federal law or the Code of Federal Regulations or in any of our 50 states do they mention Incoterms as anything that is going to be involved in their governance. But where it does come into play from a legal perspective, and that we do have to pay attention, is that when we have an international contract in place, such as a purchase order or a commercial invoice, those are recognized as a legal document in that trade transaction. And if Incoterms are incorporated into a PO, or it's incorporated into a commercial invoice or a sales or a purchasing agreement, then it has jurisdiction as part of that agreement, which has jurisdiction. But Incoterms by themselves has no jurisdiction in the United States. Having said that, most of the world does incorporate Incoterms into their legislative and legal process. So what I want to point out is the difference in the United States relative to this subject of how domestic sales and purchases differentiate from international sales and purchase. On the left-hand side, you see the Uniform Commercial Code. The right-hand side, you see Incoterms. So in the United States, states that sell product from one state to another state. So there's a company in New York selling to a company in California. If there's a company in Alaska selling to somebody in Louisiana, they're governed by the Uniform Commercial Code of Practice. If we do an international business where we're selling or purchasing from somebody overseas, Incoterms is really the preferred choice. In Incoterms, okay, and in the Uniform Commercial Code of Practice, one of the problem-specific areas relates to FOB. In international, FOB means on board an ocean-going vessel. Domestically, it means free on board any type of transportation conveyance. So a truck, a rail car, air freight, courier services would all be included. But internationally, where we're going to get into this in a few moments, where there are 11 options, the FOB is specifically designed for goods once they're on board an ocean-going vessel. So in UCCP, there are only two terms that are discussed in those regulations. One is FOB Destination, okay, and one is FOB Origin, as shown in these diagrams on this slide. So if I was selling FOB Destination, that means that I'm including the cost of the freight in my transaction, okay? If I'm selling FOB Origin, then the cost is the responsibility of the buyer who's receiving the goods. And one slight variation is FOB Shipping Point, where I prepay the freight, okay, and then bill it back to the customer, usually in the commercial invoice. This picture shows the free on board in Incoterms, where it has to be an ocean-going vessel. One of the mistakes that we often see when we audit various types of supply chains is that they'll be shipping to a domestic point, they'll be shipping to a freight forwarder, they'll be shipping it to a place in Canada or a place in Mexico, and they're using the term FOB. From an international perspective, that would be incorrect, because it would have to be an ocean-going vessel. That's the conveyance that's being utilized. The relevance of Incoterms in general terms is that it impacts the cost and risks that occur between a seller and a buyer, which directly impacts landed costs. And we're going to look at landed costs towards the end of the presentation, but they're the accumulation of costs that an importer or an exporter or anybody selling goods, even domestically, have in order to not only purchase the goods, but to move the goods to point of value, to a warehouse, to an end destination, to a customer. Relevance of Incoterms is it also impacts trade compliance, it impacts payment, it impacts revenue recognition on exports, it impacts insurance issues, and it impacts the transfer of ownership from one company to another. Give you two examples of companies that get into trouble, and we probably get referred into us by various law firms, probably I would say 2 to 3 times a month, a particular situation where an importer and exporter has gotten themselves into trouble, and the root cause of the problem is not understanding how Incoterms work. So we have a client recently in September that was an importer of bicycles in Los Angeles. And they bought the bicycles on a CIF term, cost insurance freight term, which meant that the supplier in China, where they originated the goods from, was responsible to provide the insurance while the goods were being in transit from the origin point all the way to the port of Long Beach. And they would have to supply a certificate of insurance evidencing that along with the commercial documentation. So when the goods finally arrived at their facility in outside of Long Beach, and they opened the container, what they found out was that there was a significant amount of damage. About 30% of the shipment, valued at about $500,000, was damaged. They further was found out from various sources that the vessel itself, based upon the ship's log, had actually encountered some very serious weather while it was crossing the Pacific Ocean. Hence, that's where the damage was caused. So that kind of damage would be covered under marine insurance policy. But when they went to take the insurance certificate and to try to get the claim handled by the insurance that was provided by the shipper, the origin supplier, they couldn't find any agent or of that company located in the United States. The certificate was in Chinese, so they had to have interpreted. And when it was interpreted, the coverage was in a very limited basis, what's called free of particular average, which really only covered major perils only, which was really sinking, stranding, and fire. And being that the loss didn't occur from any of those incidences, it was not covered. So the company ended up having to eat $150,000 of loss because they used an Incoterm in which the supplier provided the insurance, which is one of the recommendations we make at the end, is that on an import basis, you want to always control the insurance where you make that purchase. And if you use the Incoterm CPT or CFR, you could get the shipping covered, but you would be required to buy the insurance and in control of that. On the export side, we had a situation where a client in New Jersey was selling a container load of seafood worth close to $1 million to a company overseas, and they sold it on an ex-works basis, which basically means that they're only responsible to get the goods into the container, and from that point forward, it's the responsibility of the buyer overseas to move the goods, pay for any of the expenses, and also takes the risk of loss or damage. But their payment terms in this transaction was a site draft 60 days, which meant that once the goods arrived into Paris, France, which is where they were going. And the customer cited the documentation. They had 60 days to pay from that point in time. So when the container finally arrived in Paris, and they opened up the container, what they found out was that there was a defrosting problem that basically caused a total rejection of the shipment of $1 million. And in this case, they refused to make payment because, as far as they were concerned, the goods were never delivered to them in the condition that it was promised. So the exporter was now in a very difficult situation because they transferred not only the ownership, but the responsibility to a buyer. And it turned out that that buyer didn't insure the transaction. And that led into a dispute, which led an attorney to get involved, who then referred it to us to help the company not only help them deal with this problem, but also train them and teach them so it would never happen again. And the point being is that irrespective of the Incoterm, you need to make sure that you're protecting in an export transaction your receivable, which allows you to insure that transaction, because your interest is the fact that you haven't gotten paid. So the consequences of not paying attention, which obviously most of you are on here want to avoid the aggravation of the potential problems that occur. Risk and cost increase. Dissatisfied customers and suppliers. And obviously senior management, the organizations aren't happy when these problems arise because they all lead to financial consequence. And the opposite, when it is done right, when it is applied correctly, when there is people on staff who have an understanding of the law and the rules of how Incoterm works, there's less aggravation, there's a reduction directly in risk and cost, you have more satisfied customers and suppliers, and obviously senior management is happy. So in international transactions, we have what is the impact, and there's these list of 10 things which we have to be concerned about, 11 things. First is that the term of sale is the Incoterm, but we also have to deal with freight in an international transaction. We also have to deal with how freight gets paid, because we could do it prepaid or collect or part of the value of the transaction. We also have to pay attention to how title is dealt with in an international transaction. We have to deal with payment terms. In export transactions, we have to deal with the subject of revenue recognition. We have to make sure, as I mentioned earlier, that somebody is responsibly insuring the transaction. And appreciate that the impact does not apply to contractual disputes. It doesn't apply specifically to compliance responsibilities. It doesn't apply to specifically packing, marking, and labeling requirements. And the United States, on its imports, has security filing requirements, and it doesn't address necessarily how the importer's security filing, the ISF filing on imports, who's the responsible party. So this slide could be possibly one of the most important slides in the whole slide deck, which is, it makes a very simple understanding that Incoterms is a point in time where the responsibility and liability, or cost and risk, between a seller and a buyer, an exporter and importer, is transferred between those two parties. And I'm going to reiterate again because it's quite important to understand that an Incoterm is only a point in time where the responsibility and liability, the cost and risk, transfer between a seller and a buyer, typically an exporter and an importer. So if we look at 3 examples here, is that we have a shipment that originates in Chicago, okay, that goes to Baltimore on an ocean freight transaction where it's loaded on board the ship in Baltimore, travels by vessel to Hamburg, and then truck to Berlin. We recognize that we can break this up to 3 legs of a journey, and this is a very good way of looking at Incoterms, because what we're talking about is that point in time moves down the supply chain, and that's what the various 11 Incoterms does, is it moves the risk and the cost down the supply chain from the seller to the buyer. The first leg is always the origin to the outbound gateway. That's the domestic transit on the exporting side or the selling side. Then we have the international shipment, which is from the outbound gateway to the destination gateway. And then we have the last leg of the shipment, which is from the inbound, the inbound destination gateway to the final destination. So if we take that same example and we take 4 of the most commonly used Incoterms that's out there, XWorks, FOB, CIF, and DDP, free on board, cost, insurance, freight, and delivered duty paid. If we are an exporter and we sell XWorks, the way to visualize this is that that's where we're drawing the line in the sand in that transaction. We are the exporter in Chicago, taking our hands and crossing them and saying, we're done with responsibility for this transaction. If we said FOB Baltimore, then we're responsible to get it on board an ocean-going vessel in Baltimore. But once it gets on board, our hands are done with that transaction. If we sold CIF, cost, insurance, freight, Hamburg, we have to get it on board an ocean-going vessel and make sure that the bill of lading and the directions in that transaction is going to bring that shipment to Hamburg. Once the vessel arrives in Hamburg, my responsibility is over. And where I assume most of the responsibility is if I sell delivered duty paid, because I'm going to move the goods through that entire supply chain and all the way to a final destination. And it's inclusive of customs clearing those goods in that country and paying the duties and taxes and whatever the local charges are, including the inland freight to a destination. So when you look at this as an exporter's perspective in Chicago, I really have the least amount of risk and cost. But in Berlin, if I go DDP, is where I, as the exporter, has the greatest amount of risk and the opportunity for a problem to have occurred. And so I have to have this in mind. As it moves down the supply chain, I, as the seller, is increasing my risk and spend. On the other side of that, as the importer, as it moves towards me down the line, my risk and spend is reduced. In an import transaction, this one by air freight, I have goods that originate in Shenzhen, China. That's going to go through the airport in Hong Kong. It's going to come into JFK, New York, and eventually end at a final destination at the buyer's warehouse in Edison, New Jersey. XWorks, FCA, I can't use FOB because it's not going on an ocean-going vessel, so the option I have is free carrier at. CIP can be used for all modes of transportation, so I can use it in an air freight transaction, and DDP is bringing it all the way to destination. So if I'm now the buyer in New Jersey and I buy at XWorks Shenzhen, then I have all the cost and risk to pick up those goods at their originating facility and bring it through the entire supply chain to my facility. The risk during that transit and the financial cost is all in my pocket. If I bought it FCA Hong Kong, then once the goods get delivered to the air carrier, the seller is done, and that's where my responsibility begins. So I have the cost and risk from that point on. If I bought it CIP, okay, JFK, New York, my responsibility doesn't click in until the goods arrive at JFK. The exporter has the risk and cost to that point. If I buy DDP, then the seller in Shenzhen, the exporter in Shenzhen, has responsibility to get it all the way to the end destination, which would typically be my warehouse. And they would also handle the customs clearance when the goods come through, in this case, the port of Jersey City, where the airport is near Elizabeth. It would take it up to that point in time, and then the domestic transit all the way to the final destination. So when you view this transaction, the supplier in Shenzhen is engaging all that risk and all that cost all the way to final destination, and appreciate the fact that they're going to recover that somewhere in the commercial transaction. So I have a commercial invoice here because this is one of the implications of the choice of Incoterm. And this would be an example in an export transaction. Okay. So if I sell goods X works, my X works price is $145,000. I'm saying in this transaction, Mr. Buyer, you're going to come to my facility and pick it up. I have no responsibility for the transaction. But if I'm going to sell it FOB to get it on board an ocean vessel, I have the $145,000 plus the $800 for the inland freight to move that container from my facility to the outbound gateway. If I sell it CIF, okay, I have not only the ocean freight in that transaction, but I also have the insurance because CIF requires me to purchase an insurance policy on behalf of the buyer's interest. So as you can see, it goes from 145 to 145.8. Now I had to add the $3,000 for the ocean freight, $500 for the insurance. I now have 148,500 as the cost of this transaction. If I deliver GDP, where I'm now required to deliver it all the way to a final destination, I have the clearance charge of $125, duties and taxes, which appreciate in this case is a 10% charge. So you got $14,580 for this cost, and the total charges includes the inland freight. So I have $164,205. When we show it this way, we do it this way because anybody in the supply chain, anybody in purchasing, anybody in sales and customer service, logistics people and so forth, need to make sure that they always know what the landed costs are so that you know what your costs are, and also to the point in time where your risk begins and where it ceases. I have as a reference from one of our freight forwarders that we do some business with, a guideline that spells this all out for you, so you can use this as a reference source. I have another one from a forwarder as well that has it outlined just in a different format. They both are good references for you to use. You can print these out once you get the slide deck. So in Incoterms 2020, which is when the changes took over, the entire industry made up of the consultants like myself, the service providers, forwarders, brokers, and a lot of people were involved in import export. Back in 2019, we were told that there were going to be very significant changes in the 2020. And as we got closer to the end of 2019, we were told very quickly that they did not follow through with all the changes they were going to make, and they came out with a much more minimized 2020 Incoterms, which only had a few changes. So the first change that they did, they tried to more clearly articulate and define responsibility and liability. And when I say that, they used more of American terminology and more of Westernized terminology in how they explain things, because a lot of things were explained that were very French because it comes out of Paris, and very European. And a lot of people in the Asian market and a lot of people in the North American market complained, and they made those adjustments. So it's easier for us to read the Incoterms now than it was previously. It first brought in now the term of landed costs, the implication of Incoterms into landed costs, which is a good thing. It also offered mitigation of problems that may arise in an international transaction. And it also talked about the fact that Incoterms should be incorporated into the operating procedures of a company's supply chain. And in some cases, it started to include, not to the extent that I would suggest it did, but it does to a more minimal side, address some of the compliance issues that are involved in international trade of who's responsible relevant to an Incoterm. So the point that we make here highlighted is that properly managing Incoterms can provide competitive advantage in international transactions. So a couple of things to think about in this regard is that Incoterms are not law. They must be specified in order to apply. Incoterms do not address specific government regulations or local customs operations of ports, carriers, and trade lanes. Incoterms do not address the passage of title. They influence it, but they don't address it. Incoterms do not address revenue recognition for sales out of the United States on how exports are accounted. We have IRS and SEC regulations relevant to GAAP, the generally accepted accounting principles that define that. Incoterms are supposed to be, and for the most part are, country neutral, and Incoterms should always have a nameplate cited. You can't just say FOB or CIF. It's got to be FOB, Shippers Warehouse, CIF, Rotterdam, Netherlands. Okay, there always has to be a named place. And the more specific that you can be, getting to a particular address or a building name or a building number is really where you want to be. I appreciate that while there are lots of issues in international trade, Incoterms addresses some, but there are still a lot that are out there that it does not address. The latest revisions and change can be highlighted in these four areas. In prior years, Incoterms made changes to sometimes as much as 25, 30, 35% of the of its doctrine. But in this year, it was probably less than 5% was actually changed. So the most obvious change is renaming the term that was previously delivered at terminal, DAT, to delivered at place unloaded, DPU. And we'll look at this in a moment. The most significant change relates to the term free carrier at. Under this term, the buyer can now instruct its carrier to issue a bill of lading with an oddboard notation to the seller so that they may satisfy the terms of a letter of credit. Under the revised term, CIP, the seller is now responsible for purchasing a higher level of insurance coverage, at least 110%. Prior, it never discussed the percentage of the value of the transaction, but in the new 2020, it said it should be insured at least 110% of the value of the transaction. This insurance requirement has not changed for CIF, but it has for CIP. Incoterms 2020 rules recognize that sellers who may use their own transport to deliver goods, that the seller can do that and the Incoterms would apply. A lot of companies have their own inland transit vehicles, their drayage vehicles, and so forth. This allows them to be used that way and would be looked at as a internal third-party facilitator. So in looking at the choices for the Incoterms, okay, the ones that can be used for any mode of transportation, and I'm going to make the point later that these are the ones that we really should be focused on, okay, are Xworks, free carrier at, CPT, carriage paid to, carriage and insurance paid to, delivered place unpaid, delivered place unloaded, and delivered duty paid. FAS, FOB, CFR, and CIF can only be used for sea or inland waterway. One of the things that we expected is that in the 2010 edition, the Incoterms organization in Paris, they divided the book into these two sections, one's for any mode and one's for sea or inland water only. And we were told they did that because they said in the 2020, they intended to eliminate the ones that were set up for sea or inland waterway only and just focus on the 7 terms that we see on the left. But at the end of the day, they did not make that happen. We are anticipating that they will in the 2030 when that comes about in 9 years. So risk is looked at in these different 11 terms, that Xworks, FCA, DPU, DDP, FAS, FOB, DAP, and then CPT, CIP, CFR, and CIF. Risk passes where the delivery takes place on the column on the left, and the others risk passes at the carrier, but costs are the destination and the named place. Other factors, and you see a picture of the Incoterms book. If in fact you are very much involved in Incoterms in your business, this is a book that you should have. My slides would be a good reference point, but a better end all as a resource to use, get that Incoterms book. At the bottom of the picture, if you expand it, is actually the website that you can order it from. The basic book costs about $35. Incoterms rules do say which party to the sale the contract has the obligation to make carriage or insurance arrangements when the seller delivers the goods to the buyer, and which cost each party is responsible for. A point in time, risk, and cost. The party should be aware that the mandatory local law may override any aspect of the sale contract, including the chosen Incoterm rule. We get into compliance issues, that's a very specific thing, because U.S. Customs in their rules says to a U.S. importer or exporter, from a compliance perspective, I don't care what Incoterm you use. If you're the importer, you're going to be responsible for import customs compliance. If you're the exporter, you're going to be responsible for export customs compliance, irrespective of the Incoterm that you've used. Incoterm rules, however, say nothing about the price to be paid or the method of the payment. As I said earlier, payment is not addressed. Neither do they deal with the transfer of ownership, title, of the goods or the consequences of breach of contract dispute. These matters, other matters that they don't deal with, are normally dealt with through the express terms in the contract of sale or in the law governing the contract that's being used. So the next 12 or 13 pages are kind of an outline that I have just showing the various terms, and there's a pictorial on each page, and they kind of talk about the responsibility and the key factors that's involved in using that term. So in an ex-works transaction, from a transaction that we have as an export, it minimized the responsibility of the exporter. And you have to now reverse that. If you were an importer buying ex-works, it increases your responsibility to the greatest extent because you're picking the goods up at their facility and you're responsible for all the risk and cost from that point. Does not remove U.S. government compliance responsibility. And if you're loading the conveyance, FCA is a better choice. And recognize that in export compliance, there's a provision in export regulations called USPPI, which stands for the U.S. Principal Party in Interest. The USPPI, U.S. Principal Party in Interest, is that entity which receives the primary financial benefit for the transaction. That's you, the manufacturer, the distributor, the exporter. And that means you're the party that's responsible for any aspect of compliance, which means you need to know where those goods are ultimately going, what they're going to be used for, and if in fact you needed an export license or permission to actually sell them to a particular country or to a particular consignee. You need to make sure that in that export transaction, you're checking the denied party screening to make sure that you're not dealing with an entity that you shouldn't be dealing with, because that's one of the export regulations that you have to deal with. And you have to be careful of your payment terms, because ex-works in an export transaction, you're transferring typically your title, you're transferring typically your responsibility at the point they take possession, okay? And if they end up taking the goods and they don't pay, okay, then you have a difficult opportunity to try to recover that expense. FCA, this is the term that ultimately will replace FOB, okay? Because the FOB confusion between how it's used internationally and how it's used domestically with the UCCP, which I opened up with. So the FCA term is a much better term because it's delivered to any carry, multimodal. It doesn't make a difference whether it's an airline, a trucking company, a courier, a vessel, or hand carried. It gives you, once it's handed to the carrier, that's when your responsibility is over. FAS, freight alongside ship, is really used for break bulk and bulk commodities. It's bringing it to the goods to along the ship. And once you get it there, your responsibility is over. Free on board, remember, this has the specification can only be used for ocean freight, okay? And it's a typical transaction where your responsibility is just to get it on board the ship, okay? And once you accomplish that, your responsibility of cost and risk is over. Cost insurance paid to is another multimodal choice where you're responsible to get it on board the ship and you're to arrange delivery to a final destination port as determined by your customer telling you which one to use. CPT is very similar to CIP, but there's no insurance responsibility in the transaction. CIF is just like CIP, but CIF can only be used for ocean freight transportation, where CIP is multimodal and can be used for any form of transportation. Cost and freight is very similar to the CPT, where you're responsible to get on board a ship going to a destination overseas, a port of origin, a port of destination, but you're not responsible to insure the transaction. So it's a limited form of that CIP and the CIF transaction. Delivered at terminal is only here because that's the one that was pulled out of the 2010 edition, and now it does not exist in the 2021. Delivered at place unpaid is looked at now because it's a new one to the 2020. So the export and the transit costs outside of the importing country, customs taxes, export and transit permits, export security clearance, and cost of obtaining all official permits is the responsibility in this case of the seller. The cost of control activities such as quality control, measurement, weighing, counting, delivery of appropriate label packaging is also a responsibility. The cost related to the shipping and transport of the goods until they are unloaded and delivered to the buyer. The cost needed to obtain documents and information related to the export and transit clearance in the country of import, and the costs related to concluding the contract of carriage to that named place that it's going to. The buyer in a DPU transaction has all the costs of the import formalities, customs, taxes, import permits, import security clearance, and the cost of obtaining all the official permits. And appreciate that overseas, most countries require an import license and or an import permit or both. And any additional cost if the buyer fails to fulfill its obligation stated in the contract. And the cost needed to obtain documents related to the import clearance are also the responsibility of the buyer. Delivered at place, also a multimodal option, meaning it can be used for all modes of transit. The seller delivers the goods that are placed at the disposal of the buyer on the arriving means of transport ready for unloading at the named place of destination. So you're not responsible as a seller to arrange for the unloading, you're just delivering it to that place that is named in the contract. So I think I missed one. Okay. DDP, delivered duty paid, is you're bringing it all the way to a final destination, typically will be the warehouse of the company that you're selling to. And in that case, you're bearing all the risks, okay, of the shipment from the origin all the way to the destination, okay, and you're clearing the goods, paying duties and taxes, and have all those costs. Normally, you would recover those costs inside the contract, but you have the risk and the cost outlay initially in that transaction. Ex Works is the least amount of responsibility from a exporter's point of view, and DDP is the most amount of responsibility in that type of transaction. So a lot of companies are involved in e-commerce, and Incoterms apply with e-commerce as well. And the thing that's highlighted in green is that the seller utilizes typically in a e-commerce transaction a DDP Incoterm, which means that they're assuming all the costs and risks from the origin through to delivery, including the local charges, duties, taxes, and clearance. Because in an e-commerce transaction, 90% are not business to business, they're business to a consumer. The consumer is not prepared to deal with the customs clearance, is not cannot manage any aspect of the logistics and the transportation. So the expectation is that the seller is going to incorporate all those costs and the risks into their selling price when they do that, which for companies that are in e-commerce and exports, you really need to make sure you understand what the landed costs are so that you can protect your margin in those transactions. And appreciate the fact that if you're buying internationally in e-commerce basis, you're basically buying on a landed cost basis where your seller overseas is delivering it all the way to your door and is absorbing all those costs as part of the transaction cost that they're selling the product to you. So the thing that you need to understand is that landed cost modeling becomes really a very critical aspect. And I create a model here. Example is if I was selling speaker assemblies, each priced at $150 per unit, total cost of the order is $300, going to a customer in New Zealand. So I have the selling price in the United States is $300. The inland transportation to get it to the outbound gateway is $9. The ocean transport is $22.50. The duty on the transaction is $5. There's a currency adjustment factor because we're switching to have the customer pay us in New Zealand dollars, okay, is $5.50. And there's a documentation fee for the parties that are handling both the outbound export and the inbound customs clearance. So the total landed price to Auckland is $344. So as a seller, you need to be making sure that your margin is either protected in that number or you have to increase that selling price to protect that margin, either or. I put a little kind of calculator here for landed costs of the things that you would want to think of in that model. The FOB FCA cost of the merchandise, the pickup at the supplier, inland transportation to a port or airport, origin terminal and port fees, export license, ocean air truck, international, import clearance, duty, VAT, terminal port fees, customs review, harbor maintenance fees, cargo insurance, inland transportation, and a storage warehouse and distribution. A lot of e-commerce is handled by the integrated carriers. The integrated carriers is either DHL, UPS, or FedEx. There are some smaller companies that play in the market, but they really dominate most of the choices. So when they have their list of costs, they have incorporated all these costs into that transaction, which is generally why e-commerce internationally is a relatively expensive option as compared to e-commerce domestically, which is a relatively inexpensive option. So managing landed costs, we need to always make sure that we're monitoring these this responsibility, that we're measuring it and benchmarking it, and that we have a process of auditing, making sure that not only that we're capturing those costs in the transaction, but we're really making the kind of margin that we have as an expectation to protect the profits of our organization. So in best practices, the things that we tell companies in our consulting projects that we do is that you need in an organization to clearly define which personnel have ownership of the responsibility of incorporating Incoterms into your purchasing and sales responsibilities. Personnel training is a critical component of Incoterms, and people who should be trained are those that have touch points and the stakeholders in the transaction. Incoterm management is really a collaborative process between all the silos of an organization: purchasing, sales, customer service, operations, manufacturing, logistics, supply chain, legal, and finance. All have to be in that decision-making because there's implications in all aspects when various choices are made. Discern between the UCCP for domestic versus the Incoterms for international, which ultimately leads to SOPs, standard operating procedures, to make sure that you're incorporating them in so people know how to use them effectively based upon how management in your organization feels about risk and feels about cost. POs, contracts of sale, purchase, commercial invoices, and other related documents should all address the Incoterm being utilized. When we get involved with an insurance claim, when we get involved with a contract dispute, we look at the documentation as a starting point. And I would say to you that probably 70 to 75% of the time, 3/4 of the time, the documentation doesn't even reference the Incoterm that's being used. So how do you know what Incoterm is being used if it's not being referenced in the documentation in the transaction? It should be a procedural thing in your protocols in your company that the Incoterm be incorporated in any type of purchase order, in any type of commercial invoice, a sales contract, packing list, and the other documentation that might accompany, particularly an international transaction. So in best practices, we have very specific guidelines that we follow, that these are generic because a specific supply chain or a specific product might require some variation. But generically, I would say that probably 90% of all companies would fit into this mode. We eliminate the terms that can be only utilized for ocean or inland waterway. FAS, FOB, CIF, and CFR are those terms, okay? If you have other terms that can be used for all modes of transportation, they become better choices for you than the ones that can only be used for ocean freight. So those terms are ex-works, FCA, CIP, CPT, DAP, DPU, and DDP. And you must always bring in the concept of trade compliance, okay? In the import side, it's the ultimate consignee issue. On the export, it's that US PPI, the US principal party and interest, which are the key issues that makes you need to get involved in how compliance is impacted by the choice of the Incoterm. For imports, we do not suggest that you do DDP. Now, you might have said, based upon my pictorials a little bit earlier, that, hey, in a DDP transaction, the shipper or the seller is responsible to get it all the way to my door and have all those charges, and they take on responsibility for customs clearance, paying the duties and taxes. Appreciate that they're not going to lay that money out for you without getting it back. So somewhere in their sales price or their commercial invoice, they're going to recover those costs. But the big issue is that you're using their broker and their process to customs clear it, which may not be compliant. And you still are the importer of record in that transaction, and you're still responsible for the customs clearance, even though a third party that's not responsible to you is handling that transaction. So we prefer on the import side an ex-works, okay, or an FCA transaction in which you take responsibility of the transaction at a much earlier process, so you can take care of all the compliance responsibilities. And our experience has been that an importer that controls the choice of the freight, the carrier, the customs clearance agent, and how it moves from point A to point B will always get it at a better price when they control it, rather than buying it from their supplier. On the export side, we do not suggest that you use ex-works and or DDP, the two extremes. On the ex-works side, you're handing it off to your buyer's freight forwarder or their carrier to take the goods to them, which means that the export responsibilities that you have are being transferred to a third party. You lose control, but that US PPI issue brings you back into the responsibility because US Customs and US governing agencies say, I don't care what the Incoterm is. If you're the US PPI, you're the exporter, you're responsible for export compliance. On the other side of this equation is you don't generally, as the seller of the goods, want to take DDP as your choice, because that means you're going to be responsible for the customs clearance and the import into their country, absorbing all those costs, of which duties and taxes would be a major factor. But the problem is that you're now dealing with customs that could be 8,000 miles away, speaking a different language, working in a different time zone, and you're not familiar with their rules and regulations, and appreciate that import rules and regulations vary from one country to another, so that you don't want to take on that responsibility unless you really have to. The preferred choices on the export side is FCA, CIF, CPT, DAP, and DPU. Those are the choices that we have found that makes the risk as minimal as possible, and also the cost involved in the transaction and reducing that spend attached to that. So with that, I appreciate everybody's attendance. I really wish everybody to be well and safe, and we have time left over to open it up for some questions. So just use your chat feature or the question feature, and you're more than welcome to jump in, and I'd be happy to answer any of them.